Okay, well, good afternoon, everyone. Again, this is Michael Brown. I'm the head of commodities at Barchart, and I'm joined this afternoon by Darren Newsom, the president of Darren Newsom Analysis. This afternoon, we're going to take a look at the grain markets and get an update from Darren. A lot going on in those markets right now, so it should be an interesting half hour or so with Darren. And then following Darren, we're going to take a look at Commodity View 2.0, which was just released last month. We'll do kind of a high-level overview of Commodity View generally first, which may be a repeat for some of you that have been on before. But we'll go through that quickly, and then we'll dive into the new features, functionality, and content within Commodity View 2.0. So with that, I'll turn it over to Darren Newsom. Darren.
Thank you, Michael. And if we could go to my front slide. Those of you who have been watching the grain markets over the last, since the middle of May, know just how explosive this has been. And one of the things we're going to talk about today is the relationship that we've seen. And then those of you who have been following along with my updates, I think I have 3 times a week updates on Barchart. If you've been following along with my discussions on basis, you know just how strange this year has been, in the fact that, we've got all of these supplies out there, supposedly, reportedly, we've got all of these supplies out there yet, and we've got a futures market rally that in corn has gone more than $1, then soybeans it's gone well over $1, and basis continues to strengthen. This just isn't normal. So we're going to talk about that this afternoon. I look forward to your questions. Again, if anything, I know that this time of year, given what we have going on right now, there's hundreds of questions out there. A lot of them don't have answers. I'll fully admit that. But I'm looking forward to the discussion at the end of this program. Now, I'll do my part. Michael will do his part. We'll watch the questions as they come in. Then when we get to the end, we'll start answering as many questions. So please feel free to send in as many questions as you'd like. We're going to get to as many as we can at the end. Okay, so I call this boom time for basis because, quite honestly, nobody saw this coming. Not in the basis market, not given what we thought we knew about 2018, 2019 stocks, ending stocks, quarterly stocks, and so on. So what I think is going on, we'll get into the depth, we'll get in more in depth in what I really think is going on. But what I think is we've got a lot of interesting things that are happening right now. We're going to talk about a few of those. So Michael, if we can go to the first chart, please. Okay, this is one of the charts that I run. And what I'm looking at here is obviously the corn September 1 stocks. And all we've got going right now in the candy stripe chart onto the right-hand side is basically just the estimates coming from USDA, and I update this every month. And the red line cutting across that is ending stocks to use. And for those of you who, like me, don't really pay much attention to these monthly reports, but just kind of want a nuts and bolts Reader's Digest version of this bullish, bearish, neutral, ending stocks to use really is that. You just take ending stocks and you divide it by total demand. The higher the ending stocks number is, the more bearish one would assume a market is, because the supply demand situation is the stocks is increasing in relation to demand. And that is, I'm not an economist, but overall, that's generally bearish when you have supplies outdistancing demand. And so what we see here is that in its June report, which was released just a week ago today, that set these markets on fire, USDA estimated 2018-2019 marketing year U.S. ending stocks at 2.195 billion bushels. Again, that's the candy stripe green column over to the right-hand side. This was up 100 million bushels from the previous month and 55 million bushels from the previous year. So, we started this marketing year off, just lights out on export demand. We were going to chew into U.S. stocks. We were going to pull them down below 2 billion bushels. All of these things were going to happen. But as we get deeper, and then we're now in the fourth quarter of the marketing year, we've seen exports basically grind to a halt. And USDA's estimates now have started to climb. They climbed 100 million bushel this year, this past month, because they dropped 100 million bushel off of export demand. So again, old crop supplies, old crop stocks are growing. Demand is slowing down. Keep that in mind. It is key to what we talk about today. Ending stocks to use came in at 15.2. This is considered the second. This would be considered the second highest in modern history. I know that's a baseball phrase, but I also like to use it in markets. And really, it's only below the 15.7, 15-something, 15.7, 15.8 that we saw 2 marketing years ago, and you can see it on this chart. Now, if I go back to my analysis of where I think the September quarterly stocks number will be, which is the key to all this, which is the de facto ending stocks number for corn. I think we're going to come in. I think we could add another 200 million bushels to this. And I'm getting that basically from the slowdown that we continue to see in export demand. So I think we can add 200 million bushels to our ending stocks, and that would bring it back up to about 2.4 billion bushels. If you look at this chart, that takes it past what we saw in the 2016-17 marketing year. We would actually have the highest ending stocks on record if we get to that 2.4, and it would take ending stocks to use to 17%. So we are staring down the barrel of an increasingly bearish supply and demand situation in old crop corn. Very important to remember. I'm talking about old crop corn, the 2018-19 marketing year. Okay, Michael, let's go to the next slide. This is something I put together by taking the Commodity National Corn Price Index, or the Ncpi, and I take it. It's a weighted daily average, very useful tool. You can use it for. I mean, it's like garlic. It's a key ingredient. You can throw it in anything. I can use this index, weighted national average price. I use it for all the different grains, and it's just so useful. What I'm looking at here is the daily average for the Ncpi over the course of the 2018-19 marketing year, and what it tells me about ending stocks to use based on a historic correlation between cash price and ending stocks to use. And we think about it, and there should be a correlation. The larger ending stocks to use are, the lower the national average cash price taken on a daily average should be. The lower ending stocks to use, in other words, the tighter the situation, the higher the price. Well, the red dot is where we are here in 2018, 2019. And what's interesting to me, what really jumps out to me, is in the corn market, it almost doesn't matter. This defies what fundamental analysts preach all the time. And this correlation is so important that, we can read so much into ending stocks to use and so on and so forth. Maybe not in corn, because look at what the Ncpi, averaging about 340 this marketing year. So what's that tell us? If we look at that box, that means it could be anywhere from ending stocks to use of about 11.5% to 15.5%. Because that's the range. That's a huge range. And again, we're falling in that at about 15.2. But if we did go out to about 17%, if that's where we wind up at the end of August, when we get to the September, stocks on hand as of September 1, which we won't see until the end of September in the quarterly stocks report, look where 17% would put us. At around 220, 250, somewhere in there. So are we that grossly overpriced, or is there something going on fundamentally that the Ncpi is showing us that supply and demand is not as bearish as what I think it is, at what USDA is saying it is? Is there something going on? Because that's what the cash market does. It tells us, it shows us there's something that's going on that we may not know about. Okay, Michael, for the next slide. Here's a look at the monthly chart Pulled off my bar chart, and I got a lot of lines on here, so I apologize for that, but I like to use retracement lines and range lines and everything else. But here is a look at the monthly chart for the Ncpi going back to 2014. And 2014 is important because if we go back, I think it's in the spring of 2014, if you go all the way off to the left-hand side, you see that we topped out, we put in a major top. That is a major key bearish reversal over there in 2014. And it started the slide, or it extended the slide that we had been in. Basically, if I go back to 2012, but this is the important date, the important month to me, is that we created this, look, I like to look at patterns, this bearish key reversal that sent cash corn in a free fall. We came down, we bounced up a little bit, we came down again, getting down just below $3 in summer of 2016. But since then, we have stabilized. We've seen the corn market stabilize while we continue to add supplies. Why was this? Well, because demand continued to go up. We were increasing the domestic supplies, but we were also seeing an increase in demand for those supplies. So the actual cash corn market stabilized. Now let's look clear over to the right-hand side and then go one bar in and look at the May 2019. Here we see, if the other one that we're looking back over on the far left side is a bearish key reversal, what we've got going on here is a bullish outside month. And this looked to be a signal that we were getting ready to break out of this sideways range that we've been in basically since 2014. And when that happens, then you just flip the range. I'll talk about this here a little bit later as well. But you just flip the range and you start setting some targets to the upside using that same range that you had before. But what's important to me is what we just talked about. We're supposed to have 2.4 in the United States. We're supposed to have 2.4 billion bushels of corn on hand at the end of August, going into the next marketing year. Yet look what we did in May. Look at that explosive rally that started on May 15th and has continued into June. The biggest part of what's happened in June coming after last week's June monthly supply and demand report. Again, USDA increased old crop ending stocks 2.19 to 2.195 billion bushels, up 100 million bushels from the month before. Yet this is the type of move we're seeing in the NCPI, the weighted national cash average. To me, this is fascinating in that we've got a bullish breakout going on that completely disagrees with what we're being told, that and about every other reading that we have saying that we have bearish fundamentals. Let's go to the next slide, Michael. Okay, what I'm looking at here is where the previous chart was the national corn, it was this commodity national corn price index. Now I'm looking at the national corn, the commodity national corn basis index. And this is just the price index, again, the weighted national cash average minus nearby futures contract. And again, there's an old saying, a good friend of mine uses it in his programs all the time. It's called the golden rule. It's called the corn market, or it's grain market golden rule. First basis, then spreads, then the futures. So if you want to, as I talked about in some of my recent columns and some of my postings on Barchart itself, if you really want to get to the heart of the grain markets, you have to look at basis. And here what we see is something very unusual, something that's just not normal. If we look over to, say, early June, and this I believe is a daily chart. Yes, I pulled up a daily chart for the NCBI, not PI. This is the basis index. And what we see is that basis was running about, what is that? About 29 a quarter under by the time we got into early June. But look what's happened. Basis has strengthened by almost a dime, 8 to 9 cents, over the last couple of weeks. Almost 3 weeks now, at a time when the futures market is rallying, at a time when we're told that we're going to have 2.2 billion bushels of ending stocks, and when I'm still projecting up to 2.4 billion bushels of ending stocks. Basis should not be rallying. Basis should not be firming to this degree. Basis shouldn't be showing this kind of strength. But you want to know what's interesting? You know what I find fascinating is markets don't care about should and shouldn't. Markets just show us what's going on. And here we have a very clear picture that there's something happening in the basis market that isn't being accounted for. That isn't being accounted for in the futures market, that isn't being accounted for in all the talk and all the analysis and all this, that, and everything else. There's something else going on. There is a tightening of short-term supplies to meet whatever demand is out there. And that's what basis is showing to us right now. That's why this chart, this daily chart for the Ncpi is really interesting. One of the things that I watch every day, every week, is just to see how corn basis is doing at this extremely volatile time. So to answer some of what might be going on, let's go to the next chart. Okay, what I'm looking at here, stay with me. While commodity Barchart has the national basis index, price indexes, and so on, they also have state, region, county basis indexes you can pull up. What I'm looking at here is the regional indexes for 3 of the key states across the Midwest that just continue to get pounded by rain. And again, okay, we're looking at the old crop market. Supposedly the rain is affecting the new crop market. I don't remember what particular order these are in, but I do know the white line is the Ohio. I've got some good friends in Ohio. And last week I was on a television program with an analyst who was talking about the Ohio market. And you might have seen me talking about this. I put this in one of the posts on Barchart, where we're seeing the Ohio, and I just used the center region, so the 50 region, the Ohio market just explode. We're seeing the basis market just strengthen all the time, despite the fact that supposedly we have enough corn and that the rain that is not allowing the corn to be planted, which we'll talk about here in a little bit, is really going to affect the new crop more than the old. Couple possibilities here. One of them was what my friend, the other analyst, was talking about, is that the Eastern Corn Belt could actually be deficit corn. And I think we've got Ohio, and if I recall, I have Illinois and Indiana. I don't remember. Again, I'd have to go back and look. I apologize for not tagging those better. But I'm looking at, again, the Eastern Corn Belt, central part of the states on this particular chart. One argument is that area is just deficit corn, despite the fact that we had huge production across the Corn Belt from, basically in 2018. My argument would be, we've got the corn out there, but these producers know they're not going to get their corn in the ground. I talked to a gentleman today who out of his 4,000 expected planted acres, he's going to take prevent plant on 2,500 of them. These are just incredible numbers this year. It's just fantastic numbers that we've not seen before. We've not dealt with this situation before. So since we're not going to get the corn planted, and the new crop market is certainly reacting to that, I think it's a possibility that farmers who are holding grain on farm and it's in condition are going to continue to do so, using the rally that we see in new crop as so they're holding old crop, and they're going to spread that out and make their old crop, part new crop, because they're not going to have much new crop to sell. And by doing that, that's allowing old crop basis to continue to rally and continue to provide this underlying support to the futures market itself. I think we're seeing a distortion of the market. It's a great distortion. It's not one of those ugly things that can happen at times, but this is a great example of how basis actually starts to control things. Again, just as my friend likes to point out, first basis, then spreads and futures. So as we look across the Corn Belt and we see this contra-seasonal strength, this counterintuitive strength that we see in basis, despite the fact the futures market is posting such a strong rally, to me, it just jumps out that we've got supplies out there Again, I'm still projecting at 2.4 billion bushels. So the supplies, I believe, are still out there. They're just being held tight. They're not going to get sold this marketing year. Many of these producers, and please, if you're on here and I'm completely wrong, I have no problem with you telling me that. But to me, I see the producers holding tight, going to use some of last year's crop with a strong rally in the market to act as some of the 2019 crop that they're going to lose. So that's how I read these. And you can compare the Eastern Corn Belt to the Western Corn Belt. You compare, the Midwest to the Delta regions and all of these things with these different regional indexes. But it was the Eastern Corn Belt that really jumped out at me. And one of the things that I really wanted to highlight, because I think it makes the case for what's possibly going on here in the old crop market. Okay, so Michael, next slide, if we could, please. All right, here's the December contract, the new crop December contract that I talked about before. And again, it's a very colorful chart. I got lots of lines. I have the ability here to draw all kinds of lines, dots, studies. It's just a lot of fun for a technical analyst. And what I'm looking at here, and one of the things I really like about this is it just takes the December contracts itself. You can just take December contracts. And to me, that's important because the December contract is a beast all itself. It needs to be studied by itself. And I can compare the 2019, as we can see here. I can compare what 2019 is doing compared to all of the other December contracts and not worry about rolls and not worry about carries and inverses and all these sorts of things. And what we see, what jumps out to me, if we just look at the blue range first, and that goes up to the bottom purple line, is that we had a sideways trend basically between about 315 and 445, let's call it 455, so about a $1.40 range. Okay, in June we got up to, if I recall, 454. So we were within a penny of breaking out. Didn't do much the first week of June. And all of a sudden, post-report, when, let's see, USDA, if I go over to here, go over to the little box in its June supply and demand report, USDA dropped acreage planted and harvested by 3 million. They dropped production down to 13.6, just under 13.7 billion, and projected ending stocks down below 1.7 billion bushels. So remember, we're talking about 2.4 billion bushels in 18-19. Now we're talking about less than 1.7 billion bushels in 2019-20, a 700 million bushel change. So what we saw was, the December corn immediately shot up, took out the previous trading range between that 315 and 455, and now we flipped that range. That's what the purple lines are. If we want to know some upside targets, now we start to look at, okay, if we just add that range to the breakout point, that brings us in at about 595, just short of $6. But notice over there in, again, April 2014, where we had a high right around, what was that, about 517. So that's going to be about mid-range, what we might expect. And that could be our upside target, could be some resistance that we're looking up there is around the 515 to 525 range. So, it seems like we've moved into some pretty clear air up here, that the long-term monthly chart is showing, again, at the end of May, it was showing a bullish outside range, expecting a bullish breakout. In June, we get the bullish report. So again, technicals led what folks call fundamentals. And we got the report to get everybody excited, get the funds going, and off we went. And the market's been rallying up until overnight session into Tuesday session. Then we started to see some pressure. Not all that unusual. Simply could be nothing more than a vacuum market at this point. Again, we left a lot of air underneath this market, and we've probably burned through many of the buy orders, leaving, as I said, a vacuum underneath that could allow these corn to fall back a little bit, but without changing anything, because outside of what USDA is saying about fundamentals, there are indications fundamentals are growing more bullish. So let's go to the next slide, Michael, if we could. And this is what I'm talking about the real fundamentals of a market. And this is the December to July future spread. When I talk about fundamentals in the market, I truly do not care about, I've mentioned them a lot, but I don't look at USDA's fundamentals all that much. I let the market tell me what it believes fundamentals to be, and the commercial side of the market tips its hand through the use of future spreads. And this uptrend that we see on the far right-hand side that's taken us from a carry of about 32, 33 cents between Dec and July and cut it to about 7 or 8 cents here just at the end of last week. That is incredible commercial buying. That is incredible fear of the long-term supply and demand situation. Yeah, we see a little bit of a dip down here this week. Again, I'm not overly excited about it. I don't think it's anything to be too concerned about at this point, but it's something we have to watch. Right now, the long-term view of the commercial side of the market is bullish. It should probably stay bullish, but the thing again, markets don't care about should and shouldn't. It can change its mind at the blink of an eye. Weather forecasts change. All of a sudden, the commercial side starts hearing, more corn got planted than what's being reported. The corn looks better than what's being reported. All of these things. We could see this forward curve, this Dec to July spread, start to see its carry strengthen again. And when that happens, that will put a top in the futures market. There's something I like to always say, that the change in trend in the futures market will be preceded by a change in trend of the spreads. It just goes back to that golden rule: first basis, then spreads, then futures. That's how it's going to work. That's why we have to watch this Dec July so closely. Right now, it's still bullish, but we have to make sure this little crack that we're seeing here over on the far right-hand side doesn't become a crevice. All right, so the next slide, please, Michael. Traders. Now, this isn't something I usually look at, and those of you who have followed me over the years know that I don't usually look at this for fundamental read. This is the December 2019 to December 2020 spread. Okay, so I want to say, okay, well, it's still a future spread, so it's still showing you fundamentals. In a way, it is, but we're comparing apples to oranges here, but I think this comparison of apples and oranges is very important. Look at what the December 2019 contract has done to the versus the 2020. We were at like a 35-cent carry, and now we've gone to an inverse. Incredible move in a very short period of time. Traders love this spread. What it's saying to me, this type of move, and it's continuing, is that we have a tight situation. We know we're going to have a tighter situation in the 2019-2020 marketing year, up through the end of August 2020. But if we start comparing it to what the fundamentals could be in the 2020-21 marketing year, starting with the December 2020 contract, that could be a lot more bearish. The idea, it would not be surprising at all to see, if this year we drop down below 90 million planted acres, plant 88, 89, whatever it turns out to be. Next year, fall of 2020, spring of 2020, it would not surprise me at all to see 92, 94, maybe even 96 million acres of corn planted. And that's what this spread's showing. If I'm trading this spread, and I'm not making a recommendation here, but if I'm trading this spread, I'm loving this. I might be a little fearful about jumping in here with it already moving to an inverse, but if it pulls back at all, I'm sure it's going to draw some attention, and that's going to push it even higher. So we can also read what we can read what the commercial side of the market is thinking, but we can also read what traders, what the investors and everyone else is thinking about long-term supply and demand. In this case, looking at new crop spreads from one December contract to the next. All right, Michael, so the next chart, please. All right, so we're going to switch gears a little bit here. That was our discussion on corn. I've just got a few more minutes, so I'm going to touch base on beans. This chart to me says it all when it comes to soybeans. That, USDA went over 1 billion bushels for ending stocks in its June report, 1.07 billion bushels pulled ending stocks to use. I don't know that I've got it on there, up around 27, 28%. I've still got, by my calculations, closer to 1.6. I know I'm way too high. That's probably going to be closer to about 1.1, 1.2 billion bushels when all's said and done. Doesn't matter. I mean, what we have right now is larger than the 3 previous years combined. You could add the ending stocks we had at the end of August the last 3 years, and it won't amount to what we have right now. It's an incredibly bearish situation. I almost wrote a column about it being apocalyptic the week before the June release, USDA released its June reports. It was that ugly. You know, we're not moving any beans. We've got trade wars going here. We've got trade wars going there. We've got China, our biggest buyer in the world, buying from our competitors. We just continue to stack up our soybeans. So naturally, one would think, yeah, just like corn, this should be bearish. Let's go to the next chart, please, Michael. And here again, we see the national basis index. And rather than, you know, getting pummeled like it was at the end of 2018, I believe this is the weekly chart where the other was a daily. Here we continue to see national average soybean basis continuing to strengthen. Now, yes, it's running below where it has the last 4 years, and it's seeing its seasonal strength, which tends to top out in late July. But the key is, again, is that there's usually this inverse relationship between what's going on in the futures market and what goes on in basis. If we've got a strong futures market, if we've got a strong rally going there, and we've got plenty of soybeans on hand, which we do, basis very seldom tends to strengthen, but this is one of those cases. So let's go to the next chart, Michael. I think I'm showing you. Yeah, here's the futures market. And this is for the November, the new crop November. July has a very similar pattern where we've just, again, exploded higher, and new crop continues to go up because, and you know, in June, USDA didn't do anything with its acres. But the thought is, the problem is that this could be, or I should say the thought process is, the June report could be the most bearish report that soybeans see over the cycle of 15, 17 months. So we've seen this buying come into the market. We left a little bit of a price gap on the weekly chart, which can be considered bullish until you start calculating, and at some point that's probably going to get filled. They're going to back up and fill again. So this is the weekly chart for November soybeans. We've got soybeans screaming higher, old crop, new crop, and basis continues to go up. Again, it doesn't make any sense at all. And I think it just has to do with a similar situation that we saw in corn, except for I still believe that we are going to see, I still think that the proper term for the soybean situation in the United States is apocalyptic. It's going to have to take a serious acreage reduction in the United States here in 2019 to start to cut into our supplies, because we have blown up demand. And it's not just a trade war, but I was at a conference earlier this summer, actually a conference in Chile, where one of the speakers, great job, she did a great job with this. She talked about how the biggest threat to U.S. demand was actually the African swine fever, and that could be a long-term hit on demand for U.S. soybeans. So certainly something that we're going to have to watch, certainly something the market has pushed aside right now as we see continued strength in basis and futures. All right, Michael, next slide. And this is, again, a future spread. This is the November to July future spread, new crop. So we see that just as with corn in the D's to July, the November to July future spread, new crop, basically new crop forward curve, showing some concern over the continued wet weather, slow planting pace, possible yield cuts coming. As I said, the June report could be the most bearish that we see, and those numbers continue to get whittled down from here. So certainly seems to be into what the new crop forward curve no July spread is telling us, is we've moved from almost 50-cent carry to about a 22-cent carry. We've cut the carry in half. Again, and this thing could continue to run. We have to watch it closely, as we do with all spreads, because just as with corn, when the market tops out, it'll top out after these spreads have topped out. So next slide, please, Michael. And again, I talk a lot about carry, and I talk a lot about forward curves and so on, but what I want to look at is, what does it mean? So as I look here at the Nov to Jan, this shows, I guess it was 11.25 cent carry. Nov to July. Yeah, 21 3/4 cents. And if we use the CME's new storage rates of 8 cents per bushel per month, that means that we're only covering almost 23%. If you look at the NOVE contract, go all the way over to the right underneath the July contract that's being compared to, full commercial carry would be about 95, 96 cents, and we're running about 21, 22 cents right now. So only about 23% of full commercial carry. That is bullish. That is bullish. Normally what we've seen here over the last couple marketing years is soybean spreads covering about 70-some% of calculated full commercial carry, which is bearish. Anything greater, in my book, anything greater than 66, 67% is bearish. Anything less than 33% is bullish. And what we have right now is a bullish long-term supply and demand situation. So what the market's telling us, what the market's accounting for, is that we are going to see acreage reductions. We're going to see USDA continue to adjust lower, or we should continue to see USDA adjust lower, yield coming down, overall production coming down as well. So besides just the spreads, now we have to know how to read those spreads, what they're telling us, and we can do that with one of Barchart's tables here that shows us calculated full commercial carry. So next chart, please, Michael. Okay, that's got my part of it. This is where you can find me. I'm on Twitter. This is my website. Feel free to go there, take a look around. I'm going to turn it over to Michael now. I know he's got a discussion on everything that they've got to offer. So I'm looking forward to your questions at the end when Michael's done with his presentation. I do thank you for joining us this afternoon, and we'll be getting to your questions here very shortly.
Okay, well, thanks very much, Darren. As Darren said, think through your questions while I'm going through kind of the commodity view overview here. Feel free to send those in via the messaging board within the WebEx or the GoToMeeting suite here, and we'll address some of those questions at the end. Okay, so I'm going to cover again today a commodity view, but I also wanted to touch on 3 other areas that are part of the commodity suite of products, and that's Commodity Connect, aka AgriCharts. AgriCharts has become Commodity Connect, and so I just want to quickly go through the services that we offer under that header of products. And then we're going to talk about Commodity Match, which is our grain offer system, online grain transaction portal, as well as commodity indexes, both of which have been integrated fully into Commodity View. And you saw how Darren used the commodity indexes in a bunch of his analysis. So we'll be taking a look at some of the things that you can do with those as well. But the focus will be around Commodity View. First, Commodity Connect. So as I mentioned, AgriCharts is now Commodity Connect. So those of you that have been customers for a dozen years or more will now start seeing the Commodity Connect brand. Quick review for those that maybe don't know that brand yet. We design, build, and host websites for our customers, elevators and CTAs and brokers. We also provide branded mobile applications that you're able to provide to your clients, your growers. For those that have websites or apps of their own or third-party apps, we provide digital solutions, including market content that you can seamlessly plug into those websites or applications. We also provide tools for the elevators to manage their cash bids. So we have an admin system where you can calculate, post to the website, or distribute those bids via text and email alerts. I mentioned Commodity Match a few minutes ago. This is our electronic physical grain trading platform, which integrates to back office accounting packages. And that was previously branded as Grain Offer System. It is now Commodity Match, part of the Commodity Suite, and fully embedded into the Commodity View platform. Commodity View is where we're going to focus. That's our industry-leading commodity intelligence and trading solution. One thing to keep in mind as we go through here, Commodity View is the only platform in the industry where you can get your futures market intelligence, a plethora of cash grain market information, including cash bids, our indexes, fundamental data such as crop progress and condition reports, as well as the ability to trade both futures and physical grain, all on a single platform. It's the only place you'll see that. And then finally, coming soon, we'll release our Grains.com 2.0 solution, which will be a fully branded or white labeled solution that elevators can provide to their growers. And it'll be the portal for growers to get their market information as well as submit offers to their elevator. And there'll be more on that in future presentations. Okay, Commodity View. I've got about 3 slides here that some of you may have seen before, but for those that haven't, I just want to go through a high-level review of what is Commodity View, and then we'll dive into the features and functionality that have been introduced in 2.0. So Commodity View is our powerhouse commodity desktop solution. It's built on modern technology. It's entirely mobile and portable. As I mentioned a few minutes ago, it's really an end-to-end workflow solution for the agribusiness and for their merchandisers. And we'll learn more about that. It's a very powerful charting with specialty tools and analytics, really heavily focused on the grain markets. And as you saw with Darren's presentation, it's heavily loaded with high value and very proprietary content, and we'll talk about more of that content in a few minutes. From the standpoint of modern technology, it's completely responsive. What that means is that you can build your workspaces on your desktop and then log in on a tablet or a mobile phone. Basically, anywhere that you have internet connectivity, you'll have access to the workspaces that you build within Commodity View. There's no download or install required. It's all web-based, no firewall headaches. Since it's HTML5 browser-based, it goes where you go on any device. As we do updates, and we're doing updates frequently to add new features and enhancements, you automatically receive those. Next time you log in, you have the latest and greatest build of the product. It's secure, fast, and reliable, and it's extremely to roll out to the larger user bases. So if you have a large group of merchandisers, for example, very, very easy to build workspaces and share those workspaces and roll out to a large group of your colleagues. The technology also makes it entirely mobile and portable. Again, it's a responsive design, so it works on any device, and it's available at the office, on the road, at home, in the tractor, traveling, wherever you have internet access, you have access to Commodity View. I mentioned that it's an end-to-end workflow solution, so it's fully integrated with grain accounting software packages. It has the physical grain offer management, so you can transact physical grain in the platform. It has futures order routing, so you can hedge those physical transactions within that same platform. It has instant messaging. So I spoke with someone just yesterday who was buying a lot of grain via text message. You can do that now right through Commodity View. And then we've also introduced an Excel add-in where you can work directly in Excel to pull real-time prices, historical prices, even charts right into Excel. And we'll show some examples of how to use that with some of our proprietary content in a few minutes. There's powerful charting tools and analytics. I'm going to leave this for the time being because we take a look in a few minutes at the new charting in 2.0, and we'll cover some of this in that area. It's loaded with high value and proprietary content. We collect cash bids today from about 4,300 locations. We create our proprietary indexes, and we're going to see some of the methodology around that again and as we go through the presentation here. We have our own commodity newswires. So we've created our own news desk and newswires that we provide through our Commodity View. The fundamental data and general economic data is presented via both historical data that you can bring into charts. And it's also presented in our economic calendar, which we'll show you as well. And then, of course, there's global exchange coverage. Okay, let's take a look at Commodity View 2.0 and some of the new features and content and functionality that have been released with that new version. So it has a brand new charting library. So it's much faster, much more high performance. it has the tools and capabilities that professional technical analysts need. And evidence of that are some of the charts and graphs and analysis that you just saw from Darren a few minutes ago. We've seamlessly integrated our physical grain trading program, our platform called Commodity Match. Right within CommodityView, merchandisers can manage their full offer deck. They can create new farmers within the system. They can assign those farmers to particular locations where that farmer is authorized to submit bids or submit offers, and then they can manage those incoming offers. And those offers will alert when a price is matched on basis and futures, and it will alert the merchandiser, and the merchandiser can then act on that offer and accept it. It'll be sent to the back office system for contracting. Okay, I want to spend a little bit of time on our physical grain market intelligence. As I mentioned, over on the right-hand side here, you can see we collect intraday, not just end of day, but throughout the day, cash bids and basis updates from over 4,300 locations. This includes both the US and Canada. And we collect them not just for spot and new crop bids, but we have all forward delivery periods that the elevators are bidding for. And we've accumulated this history over a period of 10 years and cleaned and validated all of that history. So we have 10 years of history to use for analysis around the cash markets. We put that raw data through a proprietary process, a proprietary methodology that we have patent pending on. And that proprietary process uses the capacity of the grain elevators and their direct ship relationships as one of the factors in weighting those indexes. So they're not just a simple average. There's a value-added calculation there that drives the larger elevators and larger buyers to have a bigger impact on the index than a smaller elevator. So again, it's not a simple average. It's I think a much more useful index or fair price assessment than that would deliver. These indexes are available for corn, beans, and the 3 varieties of wheat. You can generate a full 12-month forward curve. So you're all familiar with forward curves in the futures markets. With this data, you can now do a 12-month forward curve on the cash markets. And these are calculated not just at the national level, but at the county, crop reporting district, state, regional, and national levels. So you can slice and dice that data in many different ways. And I've got some use cases and examples that we'll show you what you're able to do there. Okay, we have also in 2.0 introduced the Excel add-in, which is a very nice tool that allows you to work directly in Excel. So when you install the Excel add-in, when you go to Excel, you get a CommodityView login or a CommodityView menu item and a set of widgets in the ribbon where you can bring in quotes, history, charts, our ag indexes, and pull those directly in. So you've got real-time quotes that you can see up in the upper left-hand corner, historical data over on the right-hand side to do analysis there. You can even build Excel charts right within Excel. So you can do all of that without even opening up CommodityView if you wish. Okay, our economic calendar. So we've had Commodity Stats, which is our database of fundamental and economic data for some time now, but we've fully incorporated that into CommodityView in the form of an economic calendar that you see on the right-hand side, which alerts you as to which reports are coming out for the week, and then shows you what the prior value was. And when that report comes out, then it shows you the actual value and the prior value. And if there's been a revision to a previous report, it will show you that as well. And you can sort that by the different types of reports. So if you only want to see, agricultural fundamentals, you can filter it down to just that, or you can see high priority or medium priority reports and ignore the low priority. So it's a very, very useful tool to very, quickly watch the raw numbers of those reports as they come out. This data is also available in an element-sized form. So if you go through our symbol browser, you can pull up very specifically, for example, the corn planting progress for Iowa for 2019. And really drill down to that level of granularity and see the fundamental data in a chart and see the history on that. Okay, and then two other things that we've introduced is a gallery of professional level workspaces. So rather than starting from scratch and having to create your own, we have a gallery within CommodityView 2.0 where we can build, or you can build, and we park these completed workspaces. Double click on it and it pulls it into your profile and you're ready to go. You can customize and modify them from there, but you never have to start with a clean sheet of paper and wonder what to do from there. We've also introduced multi-language support. Right now it's English, Spanish, French, and Portuguese, but other languages are easy to add. And that will change all the headers, column headers, row headers, etc., to all the navigational items within CommodityView to your local language. Okay, let's take a look at some use cases around the grain prices and basis indexes, and then some things that we can do with Excel, combining with the fundamental data and the cash price data, and some of the things you can do there. Generally, the limits are only whatever your business requirements and imagination allow. There's really no limit to what you can do. So these are just some examples. Here on this chart, we're comparing the regional basis differentials across the east and west regions, and you can use that to look for freight adjusted destination bids. What are the best destinations to ship to, for example. You can compare price indexes for, say, 4 nearby counties. In this case, in the candle chart, we're looking at Boone County versus 3 other counties nearby. And you can see the differences in the price ranges for those other counties versus Boone. You can use the indexes to evaluate individual elevator bids against, say, a county average or a crop reporting district average. And overlay, in this particular case here, you can see how the elevator price and the county average have somewhat converged over time. But you can see, which elevators are competitive relative to the county index in that area. Darren has talked a lot about this in this presentation as well as in the past, but you're able to look at how is basis moving relative to the futures. And is it, are they moving in opposite directions as, we'd often expect, or are they moving in conjunction? So another valuable tool, and again, just an example. With the Excel add-in, some of the things that you can do, in this case, I've plotted a forward curve for cash indexes. So rather than just a forward curve on the futures market, here you can see the carry in the market is represented by the cash prices. And that happens to be on a national basis, but you can just as well do that on a state or regional or crop or county district. You can use the information in your own algorithms to predict basis levels 90 days out, or we are developing a methodology to also predict basis 90 days out. In this case, you're looking at the actual basis in dark blue and our predicted basis in light blue. The actual basis here in the top chart ended around the late March, early April, and you can see how directionally correct we were in the chart below, where the basis weakened pretty substantially to about 32 under, 33 under, and then proceeded to strengthen back up to about 25 under. So that prediction, was quite accurate. Still being worked on, but it's the kind of analysis that you can do as well using the very, very deep database that we provide through CommodityView. You might also want to create a calendar spread matrix on basis, and you can see here where the basis carry is strong in green or weak in red, and very quickly, it's almost like a heat map where you can very quickly see that where it's strong and where it's not. And again, you could do that on basis. You could do it on cash prices. You can do it at any geographic level that you wanted to do it on. In this case here, I used the Excel add-in to look at the 9 crop reporting districts in Iowa. I picked Iowa because it's generally square and it laid out well in Excel. But here I looked at the 8 crop reporting districts versus central Iowa. So the crop reporting district 50 is kind of the 0 points, and then you can see the cash index is very strong in southeastern Iowa and very weak in northwestern Iowa. And you can see the others in comparison. And then finally, we can take a look at crop fundamentals versus prior years. In this particular case, I looked at the national corn planting progress. I can also do it state by state, but this was national. And we are looking at the 2018 crop progress versus the 2019 crop progress. We already knew the answer to this one and how far behind we've been this year. But if you do this with, say, 5, 6, 7, 8 years rather than 2, you'll really see where this year falls in relative to 8 or 10 years, where it falls relative to, say, the 5-year norm or the 10-year average. However you want to look at it, it's all available. And you can look at, this is planting progress, you can look at, emerging, silking, denting, harvest, etc. as well. Okay, so that's some of the new features, functionality, and content in CommodityView 2.0. That includes the presentation portion of the session here, but we're happy to answer any questions that you all have. Darren, have you seen any come in while I was speaking?
No, I did not. Just a couple comments. One, they lost their audio, and one that they lost the feed. Was there any questions that I missed from earlier?
I think, the big one on the table is, given all that you had to say, and I know you're reticent to make strong recommendations, but if you had to, advise your brother-in-law farmer today on what to do with his old crop corn, what would you suggest?
Old crop corn, I'd be feeding this rally. Unless I'm in an area where there's just no planting being done, as I talked about my friend in Ohio and other parts of the Midwest, there, you can take that gamble and play your old crop as part of your new crop. But if I have old crop left, I'm holding it, and I'm in an area where most of the planting has been done, then I'm going to feed this rally. I'm going to use it to my advantage because it isn't something that we normally see, and probably shouldn't have seen it this year, but we got dealt this hand, and now we have to use it to our advantage.
Absolutely. On new crop, would you be looking at locking in a floor and be maintaining an upside with options for locking in a floor price?
You certainly could. One of the things I didn't point out on that monthly chart was the implied volatility for the futures market has skyrocketed. So options are more expensive right now. We're going to have to watch this market closely. Certainly, if you've got puts you can keep rolling them up. It's going to cost you a little bit of money to do that. High volatility markets cost more money when it comes to options anyway. So yeah, I have no problem with moving floors up. We can look at short dated options, short dated new crop options, for the July or September timeframe. Unfortunately, this year, given how late everything is, we might actually be looking at an Octave delivery period. So Yeah, it's going to be interesting. Yeah, we can certainly look at options. We can look at different types of contracting. Certainly things that we keep discussing day in and day out. But yeah, I have no fear of jumping in, except for the costs themselves of getting some puts underneath this market.
Yep, understand. Okay, very good. The other question that came in was about how to get a demo or trial of Commodity View. And my contact information is on the screen right now, so you can email or call me, or contact your sales representative at Barchart. Very good. Well, I think that concludes our presentation today. Appreciate you all joining. The video audio recording of the webinar will be available on our website in a few days. If you're not able to find it, just let me know. We'll send you the link to that as well. So thanks again for joining us, and have a wonderful afternoon.